piece I was reading, that's because of the amount of Russian crude India is buying. The quantum of Russian crude in India's basket has now gone up to 36%, beating what we buy from the Middle East. And as a huge buyer or a huge importer, that also is going to continue to have an impact on crude prices. But just Asia. Asia is looking good this morning. At least the Nikkei has also hit a record high. Nikkei over 37,000 for the first time. And let's pull up the entire Asia pack, where it's not looking too bad overall. At least Shanghai and Nikkei is okay. Hang Seng a little down in the red. Just a quick look at what happened yesterday. And I know Samina and Niraj will come to it in a bit of detail. It was the PSU stocks that were selling off. But who was selling off? If you look at the fund flows, no real clues there, because domestic and foreign investors were both buyers at the end of the day. Yesterday, of course, DII is in a much larger quantum. There is no doubt, though, that there was pressure. Now, was it the retailers coming in and looking at, now let's take some of those profits off the table? That's the question, isn't it?
Yeah, and so PSU led downtick yesterday, but it was not restricted. So, frankly, the Nifty was deceptive yesterday, right? Because if you look at the Nifty move, that was not the depiction of what was happening to portfolios. I mean, just speak to 5 people, post-market hours, and everybody was saying that the portfolios got a serious whacking. So the Nifty move yesterday, not a depiction of the pain in the portfolios. And frankly, just looking at levels per se, the max Nifty OI, put OI, is at 21,500. So that one is a key support. And if the index were to take stability at that level, it may well happen, right? Because in some senses, if you look at quant indicators, technical supports and call and put OI, it seems that, who knows, we might find some support there because the world markets aren't doing all that bad. But that may not necessarily be indicative of what happens to individual stocks within portfolios, because frankly, 2 things. One, some of the rallies were overstretched. We've been talking it for a while. So can that extend further? Maybe can. Maybe some bit of buying may not come that easily in PSUs now that people know that the valuations are overstretched. And yesterday was a big crack. And 2, I think the Bharat Forge comment yesterday would set the cat amongst the pigeons when it comes to export-oriented businesses. So not just auto ancillaries, I mean, which is of course the key thing, but some of the other exports businesses as well. And for all of you who might have missed it, I doubt anybody would have missed it, but for anybody who's missed it, look at what Baba Kalyani or the management of Bharat Forge has said. They're saying, and this is a repeat, but it is very important. They say that looking ahead in Q4 and further into FY25, we expect growth momentum to moderate. They are saying that they will outperform, but that doesn't mean anything, because if the growth momentum has significantly come off, outperformance may not necessarily lead to growth. And, this morning, we don't have the data as yet, but we were looking at, yesterday, effectively, a clutch of these expensive names came off, right? PSUs and some others. Chinmay, we don't have the data right now on the screen, but just before I hand it over to you guys, I asked our research team to just give a collation of some stocks which are trading expensive. So forget the internet stocks like Nykaa, PB Fintech, where the PE may not be the best depiction. But Landmark Cars is trading at an estimated PE multiple FY24, 2024, at some 324 times. I mean, this is seriously expensive. Hitachi Energy, 214 times. All Cargo Gati, 189 times. Mahindra Lifespace, some 150 times. These are Bloomberg estimated PE multiples, of course, so they need revision once these actual numbers come into fray. But even if you halve them, a lot of these stocks are expensive. So the broader market, some seriously expensive pockets, serious cleansing was needed. We saw the first bout. It may not be it.
Yeah, I think it may not be it. Most people are talking about another 5 to 10% correction, and this is healthy. I don't think we're still in an area where we're concerned. But just to put numbers to the PSU sell-off that we've seen, in the last 3 days, the wealth erosion from PSU stocks alone is to the tune of 3.7 lakh crore rupees. Now, putting this into perspective, if you just take a look at the historical returns, in calendar year 2021, PSU index was up 41%. In calendar year 2022, PSU index was up 23%. In calendar year 2023, we've gone up 55%. And here we are talking about a sell-off. I mean, if you just keep that in mind, what you're seeing right now is is a drop in the ocean.
A little shade.
A little shade.
Not really a cut.
But it seems to have hassled a lot of people. A couple of other things. Across the PSU basket, the government, remember, owns 30 to 90% of stake. If I have to talk about what loss every vertical has had, institutional investors have lost 93,590 crores, non-institutions have lost 45,300 crores, and individual holders have seen wealth erosion to the tune of 36,440 crores. So when Niraj talks about how portfolios beyond the headline number have impacted, that is the erosion of wealth that we've seen. For the last few months, people have been talking about how valuations look stretched, but who's to call it a top or who's to call it a bottom, right?
Exactly.
It's anybody's guess. In retrospect, we can be sitting here and telling you this is what happened and this is why it happened. But like we said, value is like Neeraj and Tamanna discussed, is a Pate Philippe in the Indian market context. But for now, PSU is not enjoying that. Well, I'll move away from that into another important factor. We'll talk about inflation as well, but maybe at a later stage, is earnings. Three earnings that we had that I have picked this morning. You've had Coal India. Numbers were actually pretty good. Now, whether the markets are going to get excited about this is going to be something we'll have to watch out for. If the sentiment is lukewarm, I don't expect a big positive up move or a rest of sell coming in for Coal India. Profits were ahead of expectations. Revenues were up 2.7%. EBITDA was up by 10%. Margins have also expanded to 31% from 29.53%. Net profits were up around 17%. Key factors is raw coal production has also grown about 10.5% year on year. Raw coal offtake has also grown 8.8%. And of course, for investors, the board has declared an interim dividend of about 5 rupees per share. So a couple of positives. Now, whether that sell-off from yesterday will be arrested on back of these numbers is something we'll have to wait and see. But independently looking at those earnings, they're actually not a bad set of earnings coming in on Coal India. Another one that I did think looked good was Dilip Bilcon. Revenue was up 24%. EBITDA was up massively, 127% to 357 crores versus 157 crores. Margins have expanded to 12.4 versus 6.76, and net profit is also up marginally. A couple of factors you want to keep in mind. While there has been an impact of finance cost was higher by 20%, and that impact you're seeing on profitability, but not on EBITDA. And that's why while margins and top line looks better than what you're actually seeing on the bottom line. Other than that, you also had the order book that's come down from 27 crores peak to 21 crores. So while those numbers don't look too bad on the face of it, when you look a little deeper, the commentary seems a little more concerning at this stage. In good news, they won 4 new projects, and that is a good positive. 100% of the equity divested in the 9 HAM projects and 49% in the 1 HAM project. So those are the few factors you want to watch out for. Could be another rough day for Dilip Bilcon, to say the least. Well, HEG revenues were up 6%, EBITDA was down 34%. Margins have also contracted 950 basis points to come in at 15.4 versus 24.9. Net profit was down almost 60% YOY. What they've done is there was a 35 crore write-off of inventory that we saw. In the same quarter last year, there was a write-on of about 110 crores. So the impact you're seeing of inventory is to the tune of about 180 crores, which is impacting the numbers for HEG. So the numbers are not bad, but because of the write-off number, you are seeing that looking a little more distorted than it should. So all in all, I don't think numbers are going to come to the rescue of any of these companies, but nevertheless, they don't look too bad, at least for Coal India to begin with for now.
In note from Nuvama on Coal India, which is quite positive actually. They've maintained a buy. They've raised the target price to 561 and have said that Coal India has posted better than expected EBITDA on lower operating expenses. Volumes have improved and lower cost to drive earnings. So at least I would say one bright spot in that, government-owned companies rainbow that we're looking at. Can't really say the same for SAIL. So Steel Authority of India's Q3 numbers are also out, and imports of steel have been at record highs in India because of construction demand, etc. This has impacted domestic companies. It's been seen on SAIL's quarter, so it's a disappointing quarter. Lower price realizations have hit profits, and this is something that the management has also said. And of course, it's the impact of those high steel imports. As a result, your revenues are down about 7%, your net profits are down about 22% for SAIL. A bit of a margin expansion, very mild, and the EBITDA is also up minimally, I would say about 3%. There is an interim dividend of just about 1 rupee per share. So that's one to watch out for. You might see a negative sentiment, already quite a bit of a crack yesterday in SAIL. Galaxy Surfactants is another one in mind. And remember, it's not just PSU stocks. Specialty chemicals have not had a great time overall. And we're going to be talking to the management a little later in the show. So the poor quarter continues. One of the things the management has said in its investor presentation is that the Red Sea escalation has impacted their volumes. We'll ask them how exactly. They also see a delay in North America recoveries, and as a result, you've seen revenues down about 13%, EBITDA down fairly sharply, nearly 27%, and profits down 32%. There is a margin contraction as well. Good news, though, for Phoenix Mills. Phoenix Mills has had a great quarter. You could even put it down to seasonality to some extent. That was a quarter when people like to shop, etc. So you've seen improved footfalls, improved occupancies at their St. Regis property as well. And they've seen rental growth up 5% in their mall, with overall consumption seeing a 25% increase. So if you were looking for a continuation of that theme, that at the higher end consumption is better, Phoenix Mills numbers definitely underline that. So you've had a pretty strong quarter. Revenues up 44%, EBITDA up more than 43%. Margins are up only at about 26 bips. So with that kind of a top line, still a bit of squeeze. But look at the net profits. You have about 62% up. There were some one-time sort of factors in Phoenix Mills as well. But overall, I would say pretty good numbers.
Yeah, solid numbers. And, you know, the seasonality aspect would be true for the December quarter previous one as well. Maybe it ties in with the urban consumption uptick. So say for landmark cars, Tamanna, which had a slightly iffy quarter, I think all urban consumption themes have done really well. And this is really done really well for itself. So it could be interesting to see what happens to the stock reaction.
All that money you've spent in Phoenix Mills has worked out if you go shopping
No,
there.
unfortunately now we are going to BKC, right? Because we are right here in BKC, can't go to Lower Parel per se.
And you're only looking at the high end. That's what BKC is.
I'm looking at the high end. I'm not buying that, I must say. But no, it's a pertinent point. So Coal India, Phoenix Mills, we're looking at good stories. So I'm bringing only good stories today. I'm doing a change, okay? So 3 stocks which have done really well in the quarter. Sansera Engineering is the first one. By the way, at TTM 30 times, Sansera is not the most expensive stock, but look at the numbers. Sales up 27% at 713 versus 560 crores. EBITDA margins expand 140 basis points to about 16.9%. And PAT up 55% at 48 versus 31 crores. It is the highest ever quarterly sales and EBITDA. The order book expanded further as well at 2,040 crores, which is a 36% YOY growth in order book. I think the only question for everything related to aerospace, defense, and auto ancillary, which is where Sansera also fits in, is that what Bharat Forge has said yesterday about how their quarterly numbers were very good. They expect quarter 4 to be okay too, but pain beyond that. Could that hold true for a Sansera or some of the others as well? I think it remains to be seen. Must say though, this is a far cry from the valuations that some of the others which have corrected yesterday is at. So therefore, Sansera could well have a good day today. Let's wait and watch. Slightly better than Sansera was Skipper. Revenues up 80% at 801 crores versus 444 crores. EBITDA up 69% and PAT doing really well for itself as well. About 115% uptick in PAT. So that too, that business has done really well for itself, and you should pay heed to the numbers that this one has posted, Skipper. I'm just trying to get you some other details for Skipper, because I think it again for Skipper to the best ever revenue quarter led by strong performance across all of the major businesses. Polymer grew 11%, infra grew 17x or 17%, and the closing order book was very healthy. So do watch out for Skipper in the session today. And slightly better than Skipper on the bottom line front or the margin front was Ashiana Housing. Revenues up 44%, strong, not as strong as Skipper, but look at the margin expansion at Ashiana Housing. 1132 basis points 17.58 versus 6.25. In these housing companies, it becomes difficult to predict whether it's a one-quarter wonder or otherwise, but good quarter and the PAT up 207%. So very likely that this will react positively too. So top three in my radar after Samina and Tamanna's are these. There are some others, but I'm sure you guys have noted something else too.
Just very quickly, I want to bring in Novelis because those earnings for Hindalco were a big bump up. We will see the reflection of that, but just to take you through that, their income has risen to $121 million, which has grown tenfold over $12 million, which was seen the same quarter last year. Remember, Hindalco will also be reporting earnings, so this will be a sort of an indicator what we can expect as it is a subsidiary of the company. Net income has grown 80%, excluding special items. Net sales, though, have actually seen a little bit of a dip. But that's that for you. Another counter we've watched every morning has been Paytm. 197 communication, if you can bring that up on the screen. There was a little bit of relief in terms of what we saw in the stock yesterday. It was left out while the rest of the markets were selling off. Quick one, there's been a downgrade coming in from Macquarie now, where they've slashed the target price to 275 from 650. So a huge cut in their target price on of course, Paytm. They've said transitioning to new banks looks very difficult for Paytm. They've said increased loss estimates by 170% and 40% over FY25 and FY26, factoring a 65% decline in revenue that they're expecting the current news flow to have on this entity. They're also assuming 50% cash burn rate and 20 times PE multiples to actually normalize earnings for the distribution part of the business. Lending partners might relook their relationship with Paytm. So those are the factors, and that's what they're very clearly concerned about. I don't think any of us can rule out another day of lower circuit on Paytm on back of that downgrade again.
The fact that Paytm was up yesterday, Samina, is interesting because it was up on the news that their deadline of Feb 29th will be pushed forward. But what the market needs to understand is that, and of course it fell off its highs of the day, but the deadline is being pushed forward for customers to exit, not really as a reprieve for Paytm. And the kind of slash that Macquarie has done in its note, 275 is where they look at it. I mean, all right, let's put aside what their earlier target price was, 650. Perhaps that was at a different time. But price target of 275 now really, in a sense, underscores the concern about the survival of this payments bank business, at least. Why would anyone come back? Who else is going to come and rescue them? The fact that they say that transitioning to new banks looks difficult is an important factor. Really, because as we have reported on NDTV Profit, that they reached out to several banks who did not want to come on board unless there was a very clear mandate from the RBI that whatever mess was allegedly happening in Paytm Payments Bank would not be on their books. There was a comment yesterday from Amitabh Chaudhary of Axis Bank saying once we get the go-ahead, we're happy to help, but they need that clarity from RBI. Harsh joining us in on more details of that Macquarie report. Harsh?
Well, yes, Tamanna. So, it's not surprising because you were going to see a second-order impact of this happening. And what Macquarie is really detailing out is with regard to just the number of customers on the Paytm platform, which are 33 crore at the moment, will go down substantially because of a lack of confidence. One, what Macquarie is clearly suggesting is that there will be a fresh KYC required according to their channel checks. They are caveating that, but as per their channel checks, there will be a fresh KYC required for customers, which will basically impact that customer count of 33 crore, which Paytm has on its platform, which will impact the top line of the company by 58% in FY25 versus FY24. So that's a very, very large number in itself. And what they are suggesting is basis their price to sales valuation, which was used for deriving the 650 rupee target price. This impact on top line itself would push the target price to 225 rupees. That's a significantly lower number. So that's the first part. Second, they are suggesting that the lending business will get impacted because lending partners will lose confidence, and they're already doing that. As per their channel checks, AB Capital, which had around 2,000 crore of loans with Paytm, now has reduced that book to 600 crore, and they are expecting other partners to follow suit as well. So all of that will impact the top line as well as the EBIT. EBIT down 71% as per their estimates versus the earlier estimates that Macquarie put out.
Well, thanks for that, Harsh. One line message, muddy waters. It's okay to buy a business 20% higher when the trend changes. Why go out and bottom fish?
Yeah, and the target price of over 50% lower than the current market price.
Yeah,
so it's painful.
All right, let's move to another theme that we're discussing today, and it's the kind of crack we're seeing in PSU stocks. We've seen it from the last two trading sessions. If I take in mind, Friday and Monday was truly brutal. If I pull up the Nifty CPSE index, it really took a hit, about 4% down. PSU Bank Index was also doing very badly. Nifty CPSE is about 5% down. Ajay Bagga joining us now for more on this. And Mr. Bagga, very good morning. Great to have you on NDTV Profit. The core question really is simply this, that is the pain over? We've been having this sort of mini debate in the studio since morning on whether ज़्यादा हो गया, putting it very simply. Have now some of these PSU counters gone into oversold territory, and what is the biggest concern?
Yeah, I think the second part is easier to answer, Tamanna. Pleasure to be on your show, and I have been now regularly watching your morning segment, and very good, insightful stuff. So I hope you get a lot more market share, which all of you deserve. But coming to your question, I think the biggest issue was valuations had run up much ahead of what the earnings were really showing up. And secondly, the fast and furious increase. PSU Bank Index, if you see over the last 1 year, has given 56% return. Your Bank Nifty is up 13%. Private Bank Index is up 14%. So clearly it was a catch-up after 13 years of underperformance. We saw a catch-up in something like the PSU Bank Index. But last 1 month, if you see what was happening with penny stocks at 90% ownership of government were getting bid up to 5 times, 6 times price to book. When your best banks are running at 2 times, 3 times, and there is no way you could justify 6 times price to book, but just because there was no free float, these were getting manipulated, and I was highlighting that even on the budget day. And now it's coming home to roost. So one was valuation, second, valuations running much ahead of earnings, and third, some amount of informed buying which led to some manipulation, which we are seeing now getting distributed in the market. So the retail players are probably left holding these stocks at higher levels. Similar story if you see railways. Normally railways will run up in anticipation of the budget, and then we see a small sell-off in railway stocks. This time the run-up was for nearly a year and a half, and again the valuations are at unjustifiable levels. Same story on PSU Power and Defense. Very good stocks, well-run stocks, good business models, will do well, but probably you have eaten the earnings growth of the next 2 years, and now there is a correction coming in.
Got it. Mr. Bagga, good morning. Niraj here, and thank you for your kind words, and thank you for seeing our segment. Just one question. I mean, the Zada Ho Gaya comment true for a clutch of other market sectors. Is it true for PSU names? Simply because if valuation concerns is the potent argument, then those concerns are not over despite the 3-day corrective move that we've seen.
I think so, Niraj. I think it will take time. Earnings have to be perceived to take on again. And right now, I think the markets will really look for stability. And if you see, yesterday the numbers were very confusing. DIIs buying, FIs also buying. So who sold was the question. It's the nature of what is happening. In January, if you see, FIs bought about 4,500 crores of IT stocks. I think the money is moving into IT and pharma, which were more under-owned, and are showing some amount of stability. Banks are not very favored, but I think we are nearer to the point where private banks will start looking better, Niraj. I think we are reaching those levels, and a little more correction, and you might see money re-entering private banks. Though banks this year will see falling margins. So, and there is no solution that will come even with rate cuts, because whenever rate cuts happen, the cycle is bad for banks for the first 2 quarters at least. The margins compress. And for our banks, the margins are already compressing. If you see from last February to this February, the deposit rates are up 80 basis points on average, and loans are up 19 basis points. So clearly there's a margin compression already on, which will exacerbate in the rest of the year. So banks are not a place to be very overweight on, but they are the largest part of the market, so you can't really hide when you have an India exposure.
Ajay, hi, it's Samina as well joining, and I just want to take a step back. What do you think has led to this sell-off? I mean, these counters have looked expensive even last week, right? Was it disappointment on earnings? Was it worries about execution? Was it the budget? Or was it simply taking profits off the table? A, and B, if an investor needs to come back and pick up some of these counters, would it be an event-based trigger or a price-based trigger that they should be watching out for, in your opinion?
It's a brilliant question, and just from experience, one knows that markets very slowly climb up stairs and they come down by the elevator, and that's what's happening. The trigger, you can say, RBI policy to some extent for the banks, where the transparency mechanism set in would hurt margins in terms of processing fees, hidden charges, documentation kind of stuff, not addressing the liquidity, and a fairly hawkish policy in staying at withdrawal of accommodation. I think that was one trigger that really set off this sell-off in the banking side. But mostly, when you have a 56% rise in a year, or if you look at the PSU indices itself had risen so fast, they fall on their own weight. It's not actually a catalyst. Somebody tries, let me try the exit door, does it open? Then they realize it's jammed, too many trying to get out, and it leads to accelerating sell-offs. That's what's happening. It does not end so soon. Normally, it takes some time to go a little lower and then consolidate around it, get confidence back. But what has changed? What is the big change in these markets? It's just the sheer domestic liquidity that's waiting on the sidelines and the global liquidity. The amount of notes that have been printed right from 2007 up to the COVID 2020, and hardly anything has been reversed. So that liquidity changes the rules. So won't be surprised if end of this week again we have these stocks going up again. That is the caveat. But normally from here you would see them going down further, and as they rise there will be sellers coming in. Somebody who lost 10%, 20% on a railway or a power stock yesterday, they would have lost confidence, and as they slowly walk up the stairs and reach that 10% level, you will get a lot of selling coming in at all those levels. So that's how markets behave. But the liquidity changes all these rules. So that's the caveat.
So very interesting points. Maybe end of the week we'll see a change in mood. Mr. Baga, and such fabulous insight from you. But just to ask the basic question, the fundamentals on which PSU stocks have been running up, and a lot of it has to do with policy continuity, which is in place, a cleanup of the books, which is ongoing. Is it some of the Q3 results that have also dampened spirits, where there's a bit of a reality check? And do you think that the fundamentals still remain strong?
Yeah, see, Tamanna, at the valuation, you're very good. But when, you get a defense stock, PSU defense stock at 65 times price earning, you really have paid for the next 2 years, 3 years, very good growth for next 2 years, 3 years. You've already paid for it. Same for the railway stocks. Same for power. There will be massive expansion of the power lenders on the renewable side. All these companies will do very well. And, the benefit of being old is, I remember 2007-8 when all the follow-on FPOs of all these power PSUs had come out at very exalted levels. And then we didn't see those prices for the next 10, 12 years. So I'm not saying we have reached that level today, but the markets in their exuberance of discounting the forward earnings have done an over-discounting. And that correction has to happen. Companies are very good. Companies are solid. Good dividend yields also. So they are the steady eddies. But you are not pricing them as steady eddies. A utility should not be getting 45 times price earning. It's a steady eddy. It keeps on making power from the river flowing or from their turbines. But it's not going to generate 5 times the power.
Yeah.
That's over the 5 years. And the expansion will come in time, but you are paying for everything without any execution risk baked in. That's what it's all okay in the while you're going up. When somebody tries to exit and can't exit, that's when you see this kind of a correction.
So that correction may still have more room to grow. That's the key takeaway, and very well explained. Thank you so much, Ajay, for joining us this morning. Always a pleasure to speak with you. We'll take a very short break. But on the other side, we're speaking with Ajit Rambhia of Ajira Ventures with his top F&O strategies for the day. We'll also be talking with Singh of Angel One and Nirav of Latan Manharlal Securities. So markets, more stock picks, all of that on the other side.
Welcome back. You're watching India Market Open. A quick check on the implied Nifty. It is expected to be another sort of day of trade where you will see a little more weakness. So while that implied Nifty indicates to a flat to slightly higher start, we cannot rule out the fact that there may be some more follow-on selling that comes through in today's day of trade. We've got Agam who's standing by with more on that. Agam, what are the FNOQs indicating? Bank Nifty looks troubled, PSU is in a lot of pain, and the benchmark itself maybe not painting on a cleaner picture.
Yeah, the Bank Nifty certainly does look troubled. That's not an understatement because, we were working with a lot of factors. We saw about a short covering on Friday, and that weakness seeped back through in yesterday's day of trade. So a lot of the gains that were made on Friday based on the short covering because of the weakness last Thursday have been given away. In fact, now we're starting to see some more downward movement coming through. So as far as the Nifty goes, 0.8% cut there, another 1.5% added towards what potentially could look like shorts. There certainly are shorts as far as the Bank Nifty is concerned because that index came off by around 1.7%, and another 3.5% added in open interest. Where does that take there, as far as the Nifty goes? Let's talk about the options market. And because the fact that the Nifty came off to a certain extent, we also saw a lot of writing around the calls, around 21,700 and 21,800 calls denoted by the green bars here. That's where we saw a little more increase in OI. That, of course, also brings us to the question of the range based on maximum open interest, which continues to stay around 22,000 call. But we have a lot more traction around 21,800, 21,900 calls as well. On the lower end, also more unwinding. As far as the 21,400, 21,500 puts are concerned, even though we have a little bit of a build-up there, but nowhere as close to what we are seeing as far as calls go. Let's move on and talk about the Fin Nifty. Of course, that's the weekly options expiry today. And a lot of the action is out of the way when it comes to 20,200. We are now keeping an eye on 20,000. In today's day of trade. The problem with Fin Nifty and perhaps the challenge here is that options tend to contract substantially in the first 1 hour of trade, and after that it really becomes hard to take short positions as far as your options are concerned, at least as far as Fin Nifty goes. And this is despite the fact that we've seen an increase in volatility and premiums have been relatively on the higher end, but that contraction is very swift, and hence the risk to reward ratio for selling options becomes unfavorable. I will also wait and watch whether or not that in fact happens today or no. But let's talk about stocks then, and of course we keep an eye on Astral and HCL Technologies, where in fact we've seen longs building up. Shorts for Ipca Labs, Bharat Forge and Nalco, and on the other hand stocks which have seen unwinding. We saw short covering in Divi's Laboratories and Escorts, and SBI, Siemens and UBL will tend to see a move downwards, so longs and winding coming through. The question really is, what do we do with all this data that we have on our hands? Let's get in an expert voice. We have Ajit Rambhia of Ajira Ventures, joining us on the show. Ajit, good morning and thanks for joining in. Let's start as usual by taking your view on the Nifty and the Bank Nifty.
Yeah, good morning, Ajit. Thanks for having me on the show. Reflecting on recent trends, our previous strategy of sell on rise has been validated by the market dynamics. So we are sticking to the same plan as right now. It feels like season for grabbing profits. We have also witnessed a pattern of healthy upside movements in various counters, followed by swift corrections. So we should keep our eyes open for such upward swings and also be ready to hit the sell button when things start to look shaky. It's all about playing smart and knowing when to cash in these gains. Talking about the indices for Nifty, we can place our support at 21,625 and resistance at around 21,850 levels. And for Bank Nifty, we can place our support at 44,950 and resistance at around 45,400 levels.
Right. So, the view from Ajit is that we need to be nimble, we need to be agile in these markets, and we need to change our view on the markets depending on exactly where they are. And of course, Ajit has already given us the supports and resistances for the two benchmarks. But Ajit, I believe you also have a view on Divi's Laboratories. We saw about a short covering as far as futures are concerned yesterday. What is your strategy on this one?
Like we have bullish on this counter, target of around 4,000 rupees. So we initiate a bullish butterfly strategy for this counter. where we buy one ATM call of 3750 at around 106 rupees. We sell 2 calls of 4,000, which is our target price, at 34 rupees, and hedge it with buying one OTM call of 4,200 at 30 rupees 25 paise. So the cost of this strategy is around 51 rupees, and we can, if it closes at our target price, we can gain around 200 rupees, which is the risk reward is around 1:4. So we try to comply such strategies where we have good risk reward ratios.
All right. Well, there is no doubt about the fact that it's a favorable risk-reward ratio, as mentioned by Ajit, 1:4. And of course, your maximum gain will be around the 4,000 mark as far as Divi's Laboratories is concerned, because that's where you have, in fact, 2 short positions coming in and thereby eating the entire premium. But let's move on and talk about the other one, and this is an Adani Group company. Ajit, can you take us through that one as well?
So we again bullish on this Adani Enterprise with a target of 3,500 by this month end. So we initiate a simple bull call spread where we buy a 3,200 call at 98 rupees and sell a 3,500 call at 28 rupees.
All right. Well, Ajit, thank you so much for getting us that update as far as Adani Enterprises is concerned. And of course, a quick reminder that Adani Enterprises is, of course, the group company which also owns the channel that you are watching. But Ajit, on that note, thank you so much for joining us and taking us through your views on the markets and also giving us a handful of trading ideas. And with that, it's back to you, Samina.
Thank you, Agam. That, of course, is the setup this morning in terms of the F&O activity. It is going to be a little bit of a weekday. Some more selling cannot be ruled out. 21,500 becomes an important level on the index. But guys, I think another important trigger that we haven't marked this morning is inflation. The number has cooled off to 5.10 for the month of January, a tad bit lower than what was expected. But let's not forget that I think the problem continues to be food inflation. That has eased off very little, come down at 8.3, down from 9.53. But if you break that down between vegetables, pulses, and cereals, the pressure is very obviously there for everyone to feel and see. What also we need to keep in mind is that call rates are still at 6.85 yesterday. So liquidity continues to remain tight. Inflation number, while it's come in at 5.1%, it is still much higher than the RBS comfort zone of 4%. So on the face of it, good number, but I don't think it's going to do much for the bond markets this morning. And of course, the bigger cue, this all is great academically, right? Yeah. Is going to be the US CPI data, the bond yields there, and that could be the bigger driver for any action that the RBI could take or the bond markets could do.
Yeah, I'm just a bit worried with the core deflation, really, the core CPI coming off the way it has.
We did talk about that.
Yeah, and that is just such a good barometer for what's happening to underlying growth. And then if you couple it with what corporate commentary seemingly like, I wonder if growth pangs could come to bite us, say maybe Q1 FY25. The core CPI number, while overall inflation remains high, and corporate commentary being slightly sluggish, is a bit of a worry.
That increases the case for the Reserve Bank not to necessarily wait for cues from the Fed and look at what's happening domestically. And very interesting comment yesterday from RBI Governor Shaktikanta Das. Let me just play that out for you, who says that he expects bond yields to soften, inflation to moderate, and the cost of government borrowing to fall.
As we move forward, as inflation has started moderating, now going forward when inflation moderates, logically the final point will be where the bond yields also come down. And in fact, I should say that look at the 10-year bond yield. The 10-year bond yield, I remember in May 2022 when we started this rate increase, the rate hike cycle in May 2022 when we started. The 10-year bond yield was 7.14% or so. Today, the 10-year bond yields have again come down to about 7.17, 7.18% in that range. But in between, the bond yields had gone up to 7.30, 7.40, and it had remained there for some time. So it is a function of your inflation level and the quantum of liquidity available in the system. If you recall, in the first year of COVID, Again, due to the efforts of the Reserve Bank and all that steps we had taken, I think that year the borrowing cost was one of the lowest so far as government borrowing was concerned. So therefore, in the intermittent period, the interest payments, as a quantum, it is linked to the bond yields. So therefore, going forward, when inflation is brought under control, I think bond yields will soften and the borrowing costs of government also should come down. Then their 10-year bond yields are in any case they have started softening, and 5-year also. Bulk of the government borrowing are in these two buckets.
Okay, well, let's just see. I mean, this is all a good debate to kind of argue about whether the RBI will do, won't do, needs to do, doesn't need to do. Let's see when the governor decides to move the needle. But what we can do is try and give you insights on what are the stocks that could be in action today. Now, let's start off with the list. Between Samina, Tamanna and me, we've spoken on the trade setup about the key stocks that you should monitor on the back of results or news. There's one more piece of news, which is that index provider MSCI has added 5 Indian stocks to its emerging market index in its February review. The changes will come into effect from close of February 29th, and there are 1 or 2 surprise inclusions, by the way. Mahima joins us with the key details. Mahima, good morning.
Good morning, Niraj. So as you rightly mentioned, the MSCI Emerging Market Index has 5 new additions. In the large cap, we have Punjab National Bank, Union Bank of India. In the mid cap, we have BHNL, NMDC, and GMR Airports Infra has been upgraded from small cap to mid cap. Now, if we talk about the domestic indexes, large cap additions include Tata Motors and Macrotech Developers. Mid cap additions include PNB and Canara Bank. And we have several stocks that have been upgraded from small cap to mid cap. These include BHEL, Persistent Systems, MRF, Suzlon Energy, and Cummins India. Talking about the emerging market small cap index, IRDEA was added to the index. Prestige Estates and RVNL was removed from it. And if we talk about the overall domestic small cap indexes, IRDEA, Vedant Fashion, Cello World were added to the index. BHEL, Persistent Systems, MRF, Suzlon were moved from small cap to mid cap, and Solar Industries India was removed. So this is the overall summary of the data that came out yesterday.
Okay, Mahima, thanks for that. I thought the inclusion of GMR Airports was also an interesting one. And let's pose the questions around all of that and more, and the index to our guests. On the fundamental side, Nirav, Head of Equity Research at Manharlal Securities. So he joins us on the show. And on the technicals and derivatives, Aamar Singh, Head Advisory, Angel One. Gentlemen, thanks so much for joining in. Aamar, I'll start off with you. What did market action yesterday tell you about what to do in the next few days? Because the Nifty, 1% can happen any given day. But just that the pain in the broader markets was very, very sharp. So what do you advise on a day like this then?
We've been clearly telling for quite some time is that the short-term trend for both the indices, or I would say all the major benchmark indices, clearly tells me that it's not going to be easy for Nifty to really rally sharply from the current levels, because the structure of the market isn't clearly spelling that out. And also, if you look at the major heavyweights, there also we are seeing a significant tussle. So on one hand, IT stocks and Reliance, they are doing well, but on the other hand, the private sector banks are really not able to, I would say, deliver returns. So that clearly tells me that there's a lot of tussle and struggle happening. And also what we are seeing is that if you look at Nifty per se, clearly it's in a no man's land. So it's more of a trendless market from a short-term perspective. And we are seeing that it is inching lower now. It's very crucial that it should not breach, because if you look at the levels somewhere around 21,450, 500, that's an immediate zone of support for Nifty. And we could witness some pullback, because yesterday's low was 21,574, and then from there it bounced back, but it was not able to sustain. Higher levels are being sold into, so this is a very small range. I would say 21,400, 21,800, that's a range. And even if it goes higher, we'll see profit booking coming in or selling pressure there as well. And also, if you look at the derivatives data, we have seen some sort of short build-up happening, but that's more or less not too much of a concern right now. Because one good aspect is that HDFC Bank is around very crucial support zones. So those support zones, if they are broken, then we could witness some significant sell-off happening in the markets as well. Otherwise, markets could consolidate, waiting for some fresh triggers as well as global or domestic triggers for the market to fire.
Right, it's a market waiting for fresh triggers. Very good morning, Aamar. Great to speak with you. Just your take on Coal India, Steel Authority, and what are your top two picks on a day of possible consolidation like this?
So looking at Coal India, we need to realize that Coal India had a stellar rally. So somewhere you have to have correction, and a correction is also always healthy in a rally. So I think that's what we are witnessing in Coal India. The stock has witnessed some sort of correction, but it's given phenomenal returns over the last I would say 5-7 months. So Coal India, if you ask me from a long-term perspective, the trend remains up, but these are very crucial resistance zones for Coal India. So the recent high that Coal India had made, so if we go back and see, so somewhere around 465, 470, now that should act as a short-term top, and we could witness some consolidation. On the downside, 400 would act as a zone of support. So any pullback towards that level can be a good buying opportunity. Upside seems to be capped around the 470 mark. Talking about the other stock which you mentioned, I'll just if you just come with the name once again.
Steel Authority, SAIL.
Yeah. I was of the same view. So if I look at SAIL, SAIL seems to have a lost steam right now because on the intermediate term trend, it has made one of those patterns which clearly tells me that top has been made for SAIL in the short term. So the 150 level, which it had recently hit the high. So now that should act as a zone of resistance. And even if we look at on the long-term charts, so somewhere in the month in September 2021, it had made around 145, 150. So 145, 150 is a very strong zone of resistance. It's not likely to breach that in a hurry. So it could witness some consolidation. It's currently on 122 odd levels. Any pullback towards 110, 100 levels, that can be a good buying opportunity where we could witness some pullback, and a 20%, 15, 20% rally from a short-term perspective is possible. So these are the levels to watch out for SAIL.
Right. We also have Nirav joining in. Nirav, hi, good morning. Are you ready to go out and shop some of those PSU names, or it's not time yet?
Yeah, thank you. Good morning, and thank you for having me on your show. First of all, I think the first 1.5 months of this year have clearly shown us that what could potentially be in store for us for the full year. And I think while last year the rally was built up on expectations, I think this time around in this year, it's going to be a performance check, a reality check. So I think on the basis of the numbers, on the basis of the results of what we have seen, I think this has been a kind of a reality check for a lot of stocks. Railway stocks in particular, while the long-term story looks very, very compelling and intact, but I think in the short term, of course, still things are yet to take off in a very, very meaningful way. So I think we still expect some more healthy correction in these railway stocks. And at this point in time, from a broad perspective of the PSU stocks, I think we would like to look at quality names which have started delivering in terms of performance. So I think there are better names in the PSU space which have delivered good results. And I think we would like to concentrate on those names.
Right. Nirav, that's a good point. Concentrate on those names. Also, I want to talk to you about some of those earnings that we've seen, and I know Tamanna talked to Aamar about Coal India. You saw those numbers. We saw that sell-off yesterday on back of the broader theme of selling that was underway. But those numbers actually look pretty good for Coal India this quarter. Would that be a trigger to arrest the fall and also a trigger for investors to jump into Coal India if needed?
If you just see the performance of Coal India, it has rallied from 230 levels to where it is currently at this point in time. So I think a lot of upside is already there in the price. So I think still this good result, this good performance will be used for profit booking by the savvy investors. So I think it would be a little bit early to jump into this stock at this point of time, because we are seeing a trend of profit booking wherever there are good results. Just a case in point, yesterday we saw Hero MotoCorp very strong set of numbers, but already the performance was there in the price, so it was used as an opportunity for profit booking. So my sense is that the way the market is behaving at this point of time, every opportunity will be used for profit booking, at least at this point of time.
All right, very quick break on the show, but we'll be right back in time for pre-open and set you up for the day's trade. Stay tuned.
Welcome back. You're watching India Market Open. While the equity markets may be a little bit of a down day for the street and maybe a little disappointed, it'd be interesting to see how the bond markets react to that inflation reading that came through yesterday. Jayesh Mehta of DSP Finance joins in. Hi Jayesh, good morning. Thank you for joining us. Interesting number. It's come in at 5.1%, so slightly higher than 5%. Do you think we can manage sub 5% over the next 2 to 3 months? And also comment on the interns, because while core inflation has eased off quite sharply, food inflation, pulses, cereals, vegetable continues to see an uptick year on year.
Hi, good morning. So inflation number, of course, it came as per the expectation. As you asked, for the next 3 months, core definitely is coming lower. And of course, people are now looking at straight FY25 projection, which is at 4.5%, and which is quite achievable. In fact, a lot of analysts are around the same levels, right? So it's like plus minus 20 basis points. So from an inflation perspective, it is at this moment, sitting today, right? Of course, you have geopolitics worldwide, logistic issues worldwide. If that really happens, that's a different story. But at this juncture, we are like looking, we should be on the target at 4.5% for FY25. So from that perspective, I think definitely we are looking, of course, even in US now, people are looking at sub-3. So global as well as local. I think on the food side, yes, we do have a challenge. We still need to see how the monsoon pans out, but that's been there every year, right? Proactive government management also has been helping, so we should be okay.
I want to really simplify this for the sake of our viewers, and it was a conversation that we in the studio were also having. And you know, we've been repeatedly saying this for over a decade, that the RBI can't cut rates because the Fed is not going to cut rates. My argument, of course, is because there's a rate differential at play, and that's going to impact the currency. But the currency is obviously monitored by the invisible hand and has been ever since we know the currency. So just for the understanding of just common man out there, tell me, why can't RBI cut rates if it needs to encourage growth? Why are we so dependent on what the Fed does? Just simplify this for us.
So absolutely right. They can cut rate, but right now headline is still at 5.1. We will see the expectation panning out maybe in the first quarter, right? Their target is still at 4%. And at the same time, growth is not really suffering. Like if you really look at this current financial year and the next financial year, both the times RBI growth target has been higher than the market. And if you look at this financial year, when RBI projected the growth number for this financial year, people were saying RBI is being too optimistic, and the actual number came higher than RBI. So from that perspective, the growth number per se, I'm not struggling. Yes, you are absolutely right. At this moment, if the growth numbers were struggling, and therefore our real rates are higher, because even if you look at 5% and we look at 6.5% monetary rate, we would still go ahead and cut it, even if US is not cutting it, right? So we would go ahead and cut it. But as of right now, we don't have the worry on the growth side of it. And to that extent, they would rather wait and watch. I'm not saying that they have to wait and watch, but at this moment, with so much uncertainty, not only U.S. interest rate, but also global geopolitical and all this stuff put together. So maybe I won't be surprised, people have given up completely saying that only after U.S. RBI will cut rate. I won't be surprised if they cut it in April policy.
That's a good point. One last question, Jayesh, and I do understand the governor has also said that he's going to be nimble, and I think that's what's most critical, keeping in mind what's happening globally as well. But of course, being a bond trader is very different from being a debt investor. And large part of our viewership is also people who'd probably be debt investors as opposed to just bond traders. What should a debt investor do? Because I know for a fact that a lot of people who entered the debt markets maybe a year or 2 years ago on anticipation of a rate cut have been hit by M2M losses. At this stage, again, early this year, we were talking about how duration is a great space to be in because we're expecting a rate cut. All that keeps happening is the rate cut expectation keeps getting pushed further down the road. What should a debt investor do at this stage with an existing portfolio? And with incremental coming in, do you think duration still is advisable?
Absolutely. In fact, that's what you started very well, right? So it's a great market for investors, right? Investors should not be really worried about 10, 20 basis point up or down move if they are basically an investor, right? It's actually a difficult market for trader, right? Because what happens is, like today, you do have a view that in 6 months' time or so, we are going to go to 680, right? So, and you are at 710. Now, does that 709, does that mean that I'm going to go one way to 709 to 680? The answer is no, right? You might go, 705, you might go to 720, 715, 712. And then again, maybe at 7, but eventually, it's not a straight road going from 710 to 680. So it becomes difficult for trader to be in and out unless they get right all the time, right? For investor, definitely, if you look at like today from a 1 year horizon point of view, at 710, you are looking at even without rate cut, with the index flows coming in. We would be going to 680 in this financial year and next financial year. And also at the same time, if you really look at it, if there is even one rate cut, maybe two, possibly two also, but even if it is one rate cut, investors going to get almost like 710 to 650, 60 basis point rally capital gains along with their coupon. So it's a pretty good level for investors to get in.
Okay. Thanks for that advice, Jayesh, and great having you this morning. Pertinent to have you, so thanks for taking the time out. Okay, back to the equity conversation. The summation seems to be that he won't be surprised if there is a move by the Reserve Bank of India before a Fed move. Now, let's see when the Fed move happens and when the Reserve Bank of India move happens. But not a bad time to get into duration as well is the summary of that conversation. But back to the equity conversation, in conversation with Amardev Singh and Nirav Shah. Now, we're looking at numbers that have played out, and the metal names seem to have a slight wobble as the reportage has gone by, because the earlier names were okay. Now we're starting to see a bit of a fiddle there. Nirav, come in on what you made of SAIL, what you made of HEG, not strictly a metal name but related, and what is the call on those names fundamentally?
So as far as SAIL is concerned, I think there was some pressure on the margins, and I think that left something more to be desired on the performance front. So SAIL, to my mind, has been a slight of a kind of a disappointment. But I think that should be in the short run, and I think things should settle down as far as the stock is concerned. And coming to the next stock, which you pointed out, HEG, I think both only two companies in this space, Graphite India Limited and HEG. This is a very, very niche space. There are a lot of entry barriers in this business. Most of the producers of graphite electrodes, they are concentrated in the developed countries like US, Japan, etc., where the cost of production is quite high. So a lot of production is likely to be diverted towards India, and I think the obvious beneficiaries of this is going to be companies like Graphite India and HEG. And one more important factor is that the focus on decarbonization and the clean energy, etc., is going to increase the demand for steel, which is going to be made through the electric arc furnace route versus the traditional blast furnace route, which used to be very, very pollutive in nature. So I think the prospects for Graphite India and HEG look very, very exciting from a long-term perspective.
Okay, from a long-term perspective, exciting. But the pre-open rates about to settle in, and we have, lo and behold, a bit of a green on the Nifty and the Nifty Bank as well. This may not last really, but for now, it seems that we'll start off on a good note, so keep that in mind. I'm going to draw attention to yesterday's stock of the day to our mind, and that is Bharat Forge. Actually, multiple stocks could have taken the crown for the stock of the day, but Bharat Forge was down about 13-14% in the session, a late trade yesterday. On the back of the comments that came in from the management around growth. Now, Aamar, just trying to sorry.
I think there was a graphics that we should raise on MCX. They're facing a technical glitch, and the teams are working to resolve the same. The markets will be open tentatively only at 10 a.m. So, quick update on that. It's beyond the stock reaction really, but if you are a trader on the MCX, trade will only resume at 10 a.m. because of a technical glitch, and that's the statement that they put up. But sorry, back to you.
No, this is big from a commodity trader's perspective for sure. The unequivocal leader of that bucket. So important update there. Actually, in MCX, by the way, is reeling with some bad numbers as well. But first go to Bharat Forge, then maybe come to him. Actually, let's talk about this. Both these. But first, Bharat Forge, Amardev Singh, a bit of not a bit of a sharp pullback yesterday. Difficult to call about charts per se, but looking at the charts, the derivative positions, etc., do you think there will be stability? Because Morgan Stanley believes there will be. It's overdone, and some other brokerages have cut the target price.
Yeah, looking at Bharat Forge, the way the stock has collapsed, I would say yesterday. So that tells me that definitely a top has been made. There's no doubt about it. And even if the stock bounces back, it could be a temporary respite or bounce back. So wouldn't recommend at least longs at the current level. And if these levels are breached, so yesterday's low, if that is breached, then we could witness some real sharp correction, another 10% correction in the stock. So yesterday's low is something which one needs to keep in mind. That was around 1116. So roughly around 1100 levels. So if 1100 levels are breached, then the next support is coming around 1000. Also, if you look at the intermediate term trend, so intermediate term trend was displaying clearly bearish divergence on the charts for quite some time, at least, and it was displaying for over the last, I would say, going back from January, second week onwards, there was bearish divergence on the chart. So that was clearly telling that the momentum is no longer there and the stock is likely to lose steam. So I wouldn't recommend any position in the stock right now.
By the way, just take a look at how Coal India has been performing in the pre-open session. And definitely some spot of green over there after the numbers, better than expected. We'll pull up Hindalco and SAIL as well. Are we going to see a bit of a pullback earlier than expected on your entire PSU pack? Difficult to say. But, as we're getting into the last leg before markets open, Aamar, I just want to get your calls for the morning.
Yeah, so the first call is, if I look at, is Zydus Life Sciences. So this is one stock which is extremely strong on the charts. We've seen the stock rally, and even if you look at the current month, the stock is up almost 12.5%. It's trading very strong on the long term as well as the intermediate term trend. So any pullback in the stock towards 845, 850, that can be a good buying opportunity with the stop loss below 820 and a target of 915 on the upside. So that is one stock one can look at. And the other is also from the, I would say, pharma space. So that is Divi's lab. So if I look at this, the stock seems to have formed a bottom around 3,700 levels. So any pullback in the stock can be used as a buying opportunity, but it's more from a trading perspective because 3,800, 3,850 is the upside one can look at with a stop loss below 3,670. So this is the other stock one can look at.
Nirav, very quickly, your take on the PSU pack. We spoke earlier in the morning before the pre-open session. Anything you would touch today, or would you look or advise exiting positions if the opportunity presents itself?
Yeah, while a large part of the PSU positions, I think we would advise to stay away from. But I think one can start looking at quality names like, for example, Bharat Electronics Limited. I think at 175 levels, we would start accumulating this stock because the performance has been quite strong. The order inflows have been strong. So we would be very, very selective as far as picking up stocks in the PSU space is concerned. But definitely, we would like to look at quality names. I think Bharat Electronics is one of them. And we would look at, especially at the shipbuilders like Cochin Shipyard or Mazgaon Docks or Garden Reach shipbuilders, etc. So I think we will start picking stocks very, very qualitatively.
Currently the talk in the circles is that the better way to play the financial space is through non-banking. And that could be capital markets, brokerages, and the list is extensive as well. JM reported numbers yesterday. The numbers were phenomenal, actually. They've seen a 46% rise in profit. No surprises there, given that the private markets have seen so much of euphoria. They've also said that their top line came in at 35% higher. The stock in pre-open trade is already up 7%. Do you think JM could be a buy till the IPO markets remain euphoric and maybe a good proxy to playing the capital market space?
Yes, definitely. Why not? Because JM Financial has reported good set of numbers. The operating environment for them remains perfect. And I think with more and more focus on M&A activity, I think definitely JM could be a beneficiary out of this.
Okay, gentlemen, stay on. About 50 seconds left and we'll come to you post-market open. But actually, since we have 44, Aamar, can I quickly ask you in 20 seconds if you can give us the one top call for this morning?
Yeah, so as I spoke, Zydus Life Sciences is one stock one can definitely look at. It's in a very strong upside momentum, has a potential to rally towards 900, 920 odd levels. So this is one stock one can definitely look at.
Okay, we'll watch out for Zydus on the upside. We should mark MCX post open and just see if indeed post the results pullback yesterday, is there more pullback because of this as well? Who knows? Hindalco is something that we should definitely keep at the top of the mind because the pre-open session is suggesting it'll start off weak. Will it pull down Nalco and some of the others along with it? Is the question that the markets will answer. And here's what the markets are saying. Flat line, really. I mean, 0.2% is as good as flat. 0.26% for the Sensex. Bring up the Bank Nifty and see if there is a bit of a short covering move at all. No, not really. Quite flattish really for the Bank Nifty as well. Yesterday there was a bit of a serious pullback there. Mid caps and small caps, which are the pain points. I wonder if small caps have corrected a bit more than the mid caps. Pull that index up and that too is flatlining. So no great shakes really. Bring up the heat map. I think individual stocks will be moving a lot more than what the flat line is suggesting. So on the downside, Hindalco 9.5%, the stock of the morning, 9.5% down, nearly 10% down for Hindalco. This is the big headline from the market open this morning. Some others like Power Grid, JSW Steel, okay, but this baby out here is the one which is sulking the most and deserves all the mention on a day when the market breadth is actually positive on the Nifty on open. So Hindalco quite strongly the stock that we should focus on. We'll talk to Nirav and Aamar about it immediately post market spotting. Coal India is reacting positively to numbers ahead of Bloomberg estimates, so 2.5% higher. There is strength in Hero MotoCorp. Got punished yesterday, but today a slew of brokerages have come out with views which are very positive. HSBC for one has increased the target price quite stiffly. That is reacting, a bit of a reaction for ICICI Bank, Reliance. Now you know why the Nifty is finding the strength. Heavyweights are piling on the gains. There is strength in SBI as well. Actually not strength really, but kind of there. So not bad going for the index, being dragged down maybe a couple of little by metal names, but banks are doing the trick this morning for pulling the index higher. Opposing factors on the metals index at play, Tamanna, is the news from the index. What about the broader end?
Absolutely. Let's pull up what's happening to the mid-cap and small-cap indices as well, because those have been the pain points. Relatively, your top-line indices have been fine and not too bad, actually, this morning. Very flat and not really seeing too much pain. Let's pull up the small-cap as well for a second and see what's happening there. So nothing massively to rue about this morning, a consolidation phase perhaps, but stock specific, that's where the story always lies. So let's start with what's happening with Paytm. A Macquarie note today plummets its target price to 275. The stock making every attempt to actually get there, down about 6%. Bharat Forge is the other one we should talk about, already punished by the markets yesterday for their honesty in a sense, talking about how they see growth moderating. Brokerages have also cut their targets. Let's talk about it. 4%. Coal India, SAIL and Phoenix Mills are the other ones we're talking about. Coal, Niraj already mentioned, has had a good morning, maybe paring down from its initial inputs. SAIL down about 4%. Again, disappointing results. Phoenix Mills numbers actually look good on first sight, but is not responding too positively this morning. But a lot more action taking place. Samina, what's on your list?
A few stocks, but I'm just surprised of why we are seeing the reaction that we are, and we'll discuss that on Hindalco. Novelis numbers didn't look too bad on the face of it. Now, unless the commentary has something more than what is catching our eye, is going to be important to see. Remember, Hindalco usually reports soon after you have its subsidiary Novelis report. So nervousness very clearly being felt on Hindalco this morning. A 10% cut is what we have. Beyond Hindalco, in the broader market, some excitement for a few names. And we don't think traders are going to get carried away on this, but remember, railway names have been getting beaten out in the last few weeks. We continue to see some, interestingly, we see some buying across those plays. So the Indian IRFC is seeing a 5% up move. Now, this is coming after many, many days of underperformance. Remember, railway stocks had started selling off even before the larger PSU basket was getting dumped. So just before the budget is when railway stocks were seeing some weakness. So these are the first guys that are recovering now in terms of trade and seeing some buying. So IRFC, RVNL, IRCTC are all making, Titagarh, Jupiter, are all seeing marginal upticks. You want to remember that earnings for some of these counters have not been very impressive. But keeping that in mind, despite that, you are seeing a movement. Paytm is not taking it to the chin, which is a little bit of good news coming in for Paytm investors. The stock is down, but far away from lower circuit just yet. Threatening levels of 400 on Paytm for now, about 4% lower on the counter. Apart from that, you've got JM Financial. Like I said, fantastic quarter for them. The euphoria and buoyancy in the IPO market is one big reason why JM Financial has had such a superb quarter. That was reflected in its earnings. The commentary remains solid. The stock is up 5% in early trade this morning. Well, apart from that, you've got GMR Airports. They posted numbers too. Good earnings there, 3.5% higher. Some of your PSU banks that Tamanna and Niraj have both mentioned are seeing buying coming in trade. Whether or not this is going to sustain for even the day is something we'll have to wait and see. But for now, the early ticks don't look too disturbing. So waking up to some gains after a pretty rough yesterday that we saw. Well, MCX, despite a notification this morning that they are going to be dealing with a technical issue and only trade or open the exchanges at 10 a.m. is seeing a little bit of a gain. 1% higher is what we have on it. Niraj, you want to come in on Hindalco, I guess?
Yeah, so just one of the notes seems to suggest that the cost and time overrun of its Greenfield Bay Minute project would be the key overhang. The cost overruns are $4.1 billion from the $2.5 billion estimated initially. So I think that cost overrun, the key and the delay seems to be that pickle because both CLSA is saying that, and I think Jeffrey is also...
$4 billion, you said.
Yeah, 4.1 billion now, the estimated cost, versus 2.5 billion estimated earlier.
Double down.
So it's a very large cost overrun and a delay in the project. I think that is probably hurting Novelis.
Because it must be just that. There's been a tenfold increase. Otherwise, if you look at the other parameters of the number, but clearly the brokerages have got that cost overrun, a delay of capacity coming online, so everything sort of getting pushed down by a few quarters is what is probably disappointing Novelis and Hindalco investors. Hindalco is seeing weakness, but along with that, all cargo logistics, we talked about how expensive this stock is, and of course the recent news flow means the stock is down another 7% this morning. HEG numbers were weak, 4.5% cut on the stock. Dilip Bilkon as well. While we're at it, let's quickly take a look at what's happening on that. HEG is down 5%. Dilip Bilkon is trading flat. Orion Pro, if I can pull that one up, they've talked about fundraising plans, approved fundraising plans to the tune of 200 crores. The stock market doesn't like that too much. A 2% cut is what we are seeing. GMR Airports has been included in the MSCI index. On back of that, you are seeing a 2.5% move on GMR Infra. Coal India, on back of earnings, trades 1% higher. So different news points, but I think the inclusion in the MSCI as well, Niraj and Tamanna, is helping a few of those counters on the street. But I am still concerned, even though there's a lot of green, this is going to be a tough market to trade today.
I wouldn't say a lot of green, but yes, relatively, you're seeing maybe not as much of a hit yesterday. Market still consolidating and settling. Very quick first takes from Nirav, first post-market takes from Nirav and Aamar before we thank them. Nirav, let's start with you. Do you think that the Hindalco panic is overdone or more pain to come?
I think there's more pain to come, and I think this opportunity will be used by traders, of course, to lighten up their positions. So I think it's a bit too early to enter into the stock.
Yeah, okay. Let me take that to you, too, Aamar. Any opening comments or observations on how markets have opened completely flat negative territory, but Hindalco specifically?
Yeah, I would say markets would be trading this way because there's not much of a trigger right now which is really supporting the market. So we are lacking positive triggers. There's not negative triggers, so that also is something positive. Now coming to Hindalco is at very crucial support zone. So I would say that if it breaches the 500 levels, because on the long-term charts, intermediate-term trend, that's a very strong support zone. If that is taken out, then we could witness another 8 to 10% correction in the stock if it starts breaching and sustaining below the 500 levels.
Absolutely. So Hindalco to keep an eye on further if it drops below the 500 levels. Thank you so much, Nirav and Aamar, for speaking with us today. We're taking a very short break, but stay tuned. Ashwath Ram of Cummins Group joins us on the other side to talk about their quarterly performance. We'll be right back.
Right, back with India Market Open right here on NDTV Profit, and there are many reasons to talk to Mr. Ashwath of Cummins. Their numbers were very strong in Q3. It's a large company and has a great insight into what's happening around the world. And after the last few set of comments that have come in from business leaders around the lack of the tenacity of growth and the possibility of that is, I think it's important to get him in today, not just from a perspective of what they've done in Q3 and what could happen to Cummins, but from an overarching perspective. He joins us right now on the show. Mr. Ram, great having you. Thanks for taking the time out.
Nice to talk to you.
Yep. Lovely having you. Can I start off with a broad view and then I'll come to Cummins. Yesterday, we were talking to the management of Bharat Forge. In the press release, they mentioned about how they are cautious about how growth could turn out in Q4 and well into FY25. And then in the interview with us, they mentioned about how, looking at how Chinese growth is faltering, how Europe is looking dodgy, it is very unlikely that growth could remain very productive, especially for businesses which traverse both the domestic and the global landscape. Now, you do that. Your group does that. Give us a sense of how you are sensing growth overall and for Cummins at large into Q4 and into FY25.
So we ended the quarters strong both in India as well as globally with record numbers everywhere. So we are coming into the new year in a very strong manner. But we did start to see a whole bunch of softening in some of the export markets, especially in our power generation business. We saw that markets across the world, whether it be Latin America, North America, Middle East, Africa, China, and even Asia Pacific, Europe especially, all of those markets consistently slowed down, and they've been slowing down for roughly about 2 quarters. And that reflects in our results as well. We think we have bottomed out as far as the power generation business is concerned, and now should start to see it ticking upwards. But the businesses that we are in, the biggest businesses that we are in the automotive, trucking market, etc., globally, those are highly cyclical markets. And they have been on an upcycle now for nearly 3.5, 4 years. So at some stage, they are likely to come down. We haven't seen that softening as yet, but it is inevitable. It always happens. So it's just a question of when will it start to soften. And so companies like Cummins are taking precautionary measures. We are tightening our belts further. We are trying to strengthen our portfolios. We are trying to work on market share, on product. As far as the domestic market is concerned, as far as Cummins India is concerned, the domestic market still remains strong for the markets that we serve. As a matter of fact, in the previous quarter, most of the growth was because of the domestic market being extremely strong. As a matter of fact, exports was down nearly 40%. So despite that, we were able to grow pretty substantially. If I look at the order boards now, they seem pretty robust. But it's, again, even power generation is a cyclical market. If the infrastructure spending does not continue, if because of elections there's a pause in spending within our country, if we don't spend on road construction, if we don't spend on building ports, mobility, other forms of infrastructure, if we don't spend on enhancing the power grid, if we don't do more mining, I think all of those activities can result in Cummins business also at some stage slowing down. But right now, we are pretty optimistic about where the India story is and how we are doing there, while we remain very cautious about the global market and continue to take measures to try to ensure we are cost optimized, as well as we have the right kind of product portfolio to be able to fight in that market, even if it were to weaken.
Okay, Mr. Ram, just wondering, so on the call, if I'm not wrong, you mentioned that the domestic scenario thus far looks, you are upbeat about that, and on the export side, maybe the weakness was due to inventory destocking, but you see that bottoming out as well. Now, my question is, are you sensing that in conversations with clients as well, that as things, I understand that there should be a note of caution because the world growth is looking anemic, so you sounded that out. But as things stand, is there a need to worry or because of client conversations, or is there a need to worry only because of the larger belief that growth may slow down? Are client conversations still strong?
Well, client conversations don't typically last beyond 1 or 2 quarters. So for 1 or 2 quarters, it appears to be reasonably okay. Beyond that is what one worries about. We do see some softness even in India in the automotive side of the business, but Cummins India Limited, the publicly listed company, does not really play in that space, so it's not something to be concerned about.
Okay. Again, there's a lot of this Red Sea volatility, so on and so forth, currently ongoing. Maybe it impacted you a little bit in Q3. Maybe it is impacting a little bit in Q4. How are cost issues coming up? Because there have been multiple companies, Novelis yesterday, a couple of others earlier in the quarter, which have cited cost overruns and delays in project ramp-ups as well. What is your sense, Mr. Ram?
Yeah, there is a little bit of that happening. So because of the turmoil in the Red Sea, you can't get ships through the Suez Canal. So they are going all the way around the Horn of Africa, and that is adding 4 to 6 weeks for any material that you want to get from those countries, as well as you want to ship to them. So that is adding to that. And so if you want some emergency parts, you're going to have to air freight it. Also, the freight rates have gone up pretty significantly because the risk has gone up. So all of that is impacting a little bit, but not to a very, very major extent. What will impact us more is that some of the commodities are starting to go up. So some of the commodities like copper, CR, ferrous materials, those commodities have now bottomed out and are now increasing in cost. That is likely to have a greater impact on profitability than some of these blips in logistics and other kinds of costs. But we are tightening our belt a lot continuously. So we're trying to keep ahead of that. It's never an easy challenge, but that's what we are working on.
Okay. Do you expect margin stability, Mr. Ram?
Do I expect what? Could you repeat
margin stability?
We've been working on that for quite a while, so we are trying to hold. There is a lot of pressure in the market. India, as you know, is one of the most competitive, pricing and cost pressure kind of markets. But we have continued to grow the profit mainly because last quarter we had a trifecta of good news. We had the margins improve because we continue to hold on to our prices. We continued to get the benefit of commodities, and we continued our cost reduction activities. So a combination of all of those variables turned out positive, and so the profit went up significantly. To hold it at that level is going to be a challenge, but that's what we're working on.
Mr. Ram, one final question. This whole conversation around CPCB4 and what it would mean for sales, but there is a pricing uptick that comes into you as well. As you look at or gaze out at 2024, what is that cost versus margin or volume versus pricing metric that you could leave us with regards to this issue and in general?
Yeah, as of end of the calendar year, less than 20% of our sales have been with CPCB4 plus products. The good news is that 20% of our product sale has been with a CPCB4 plus product in a market where CPCB2 product, which is 25 to 30% cheaper, is also available. So customers are accepting those products well. They have been performing well in the market, which bodes well for when the compulsory transition will happen in ending June of this year. So we have just about 2 quarters left when all the CPCB2 inventory has to be cleaned out of the system and scale up and ramp up the CPCB4 Plus, which we have been ready for nearly a year now. So I think it puts us in a good position. You won't get realization of incremental margins till you have economies of scale. You understand the whole landscape of what competition is going to do as far as pricing is concerned. And so I won't be able to comment to say that whether because we are transition to a more expensive product, that margins will necessarily improve. But there are opportunities if what our hypothesis is that our products are amongst the best in the market. If that hypothesis holds true, we should be able to maintain at these high levels of margins, or even be able to get a little bit of improvement.
Got it. Mr. Ram, a quick 30-second. We are out of time completely, but just wondering, you reckon the return ratios could improve? Because along with margins, brokerages believe that that is going to be a definitive case, that your return ratios, ROIC, ROC, etc., will all see improvement over the course of the next 12 to 24 months.
Yeah, each of those variables over the last 4 years have been improving significantly.
Yes.
And we, as management, are pretty focused on ensuring we run this company in a very lean and professional way. So I do see those ratios. We continue to work on improving those ratios. So yeah, I think those will keep improving.
Great. Mr. Ram, lovely talking to you. Thanks for taking the time out and speaking to us, and all the best for the quarters ahead.
Thank you. Great talking to you too.
Yep. Thank you. Well, that's Cummins India, and the commentary not as skittish as Bharat Forge's commentary. Different segments, yes, but both of them cater to export and domestic markets, and they're saying that thus far in their businesses they haven't seen as much of an issue.
Yeah.
Interesting.
Yeah.
Interesting contrast.
But exports do seem to still have an overhang.
Yeah.
They're not saying
hopefully they're bottoming out, but
yeah, that is anybody's guess.
Anybody's guess, yeah.
Bharat Forge, meanwhile, having a bit of a tough morning after all of those range of downgrades from brokers, down about 4.5%. Markets overall, though, not in too much of pain, holding up their own. Bank Nifty showing decent recovery. But we are talking to companies on what their quarter is looking like, and Samvardhona Motherson has seen a double-digit rise in its Q3 profit and revenue. My colleague Tushar Singh spoke to the management. Listen in.
Hello, welcome to NDTV Profit. Joining us today is Mr. Pankaj Mital. He is the CEO of Samvardhona Motherson International, and Mr. Kunal Malani. He is the Group CFO of the Motherson Group. They're speaking to us a couple of hours after Samvardhona Motherson International declared its earnings, where revenue jumped almost 27%, net profit was about 27% up, as well as the EBITDA was up about 49%. Gentlemen, first of all, welcome to NDTV Profit.
Thank you very much.
My first question is to you, Mr. Malani. Clearly a stellar set of numbers as we look at, but M&A or acquisitions have actually contributed to a large chunk of your top line as well as profitability. But if we remove that, how does that picture look in the quarter gone by?
Even then, I think the quarterly performance would have shown an improvement. The top line would have been a little bit more muted, but the EBITDA would have expanded versus the previous year as well. So whichever way you cut it, I think it's a strong set of numbers. What did play out in this quarter is if you look at the vehicle mix, it didn't go as per the plan of the OEMs. There was a degree of premiumization that was occurring so far. This is the first quarter we saw some dip in that premiumization, but that's largely driven in our view of some of the launches which got postponed. So as those launches come on board, I think the trajectory of premiumization will again kickstart, and hence it seems like a temporary blip right now.
Coming to you, Mr. Mital, in your exchange filings that you have mentioned about a production decline quarter on quarter, is that a trend that you're seeing that will continue for the rest of the year? Or is there going to be a jump here on or a revival here on as far as production is concerned?
No, productions across the world, if you look at the vehicle production, it has grown. And as Kunal was mentioning, in some of the geographies, there have been model changes, like it didn't go as planned by the OEMs. The electrification or the embedment of EV vehicles has not taken place at the same pace that it was envisaged. So more ICE vehicles were produced than the EV vehicles. We at Motherson are in a very unique and sweet spot. All our products are powertrain agnostic. So whether they're ICE vehicles, EV vehicles, hydrogen vehicles, whichever vehicles will come in, or hybrid vehicles, our products remain there, and we continue to gain by having a more content per car.
You talk about that Motherson International is in a sweet spot. We see your segment-wise earnings as well. Any standout performance there? What is getting more traction and what is getting less traction at this point of time, sir?
So you are asking a question like you have many kids and which one is doing better. Actually, if you look at the performance of all our divisions and all the team members around the world, they've performed really well. They worked really hard and contributed to make the overall performance of the company look good. So looking at all the divisional performances, you will find that all of them have performed very well, except some areas like there were interruptions in US, which impacted some of our performances due to UAW strikes at some of the car makers, which led to lower numbers in the last quarter. But apart from that and some other volatilities which are across the world, the teams have done really well in spite of all these issues.
Okay. Mr. Malani, let's talk a little bit about the premiumization that is at play, at least in the auto space, at least in passenger car space. How is that playing out for you? So in India, we see buyers moving on to SUVs. The trend is not similar as when it comes to a geography like Europe. We saw your investor presentation. There is a slight decline in the adoption of SUVs. So how does that reflect on your margins, this particular picture? And how does that fit in with EVs? So can you give us a color on the impact of premiumization or lack of it on margins?
Difficult to talk about it from margin perspective, but purely from top line perspective, obviously our strength on the premium vehicles is a lot more than the mass-oriented vehicles. So we've been gaining a lot of share as the premiumization has played out. We do not see this one quarter blip as a trend. We see this as only a blip. As I said, we are expecting a lot more launches to happen, which should start directionally improving this trend. EV that Pankaj was mentioning about, we saw that dip as well in Europe. Again, as some new launches come in, we anticipate it to improve from here on. I think what is, however, clear is the adoption rates are a little bit unknown, specifically on the EV side. So the pace of this change is little unclear. But the trend, I don't see a change in the trend, and hence the premiumization piece will play out, as is being predicted by all the global agencies as well. So the data that you're referring to on the slide is a reflection of how S&P Global is looking at it, and that's their prediction as well in terms of how the future trend will again catch on to the premiumization trend.
Okay, sir. How does, in that sense, Mr. Mital, how does that your capex plan fit in? You say that about 50% of your 1,800 crore capex is already utilized for supporting growth in EMs. How is that picture evolving? Are you going to increase your capex outlay in FY25? Will it be more towards greenfield expansion, brownfield expansion? Just give us some picture on that, sir.
See, as of now, the majority of the greenfield expansion which is happening is in India. As you would have seen that the Indian car makers, they are growing, they're setting up new facilities, they're expanding, and we are also expanding together with them to support them in all the regions and where they're setting up the new plants. So that is the biggest expansion which we are taking place at this moment. And in the next year, we will be coming closer to the start of the year, when we will be releasing our capex guidance for the coming financial year.
So any new plans that will go on the floors in 2024?
Oh yes, there are plans. So we have new greenfields, about 11 of them which are coming up, and a lot of them will be coming in this next quarter, some of them, and majority of them will be finished within the year 25.
So no plans of expanding your capex?
In the coming year, of course, we will be building more and expanding as to where the customers want us to be. And with the new acquisitions also, whatever the acquisitions are happening, wherever they need support, we will never shy away from working together with them. And Kunal, you can add more to it as well.
And that's keeping in mind the production scenario or the kind of slowdown that we are seeing in the global space? Your expansion plans as well?
As I told you earlier, that we are seeing growth in India at the moment, and we are expanding in India. So the greenfield sites are coming all in India. Nearly out of 11, 10 of them are coming up in India.
All right, so that was the management of SAMIL talking about their quarter. But as we continue to keep our focus on numbers, let's turn our attention to Galaxy Surfactants. Now, this specialty chemicals company has not necessarily had the best quarter. Q3 has seen some estimates missed. Margins have narrowed about 200 odd bips. EBITDA is down 27%. Net profits are down about 30 to 33%, and so are revenues. I'm speaking now with K. Natarajan, the Executive Director and COO at Galaxy Surfactants. Mr. Natarajan, thank you for joining us here on NDTV Profit and taking all of our questions. Can we understand what has happened in this quarter specifically? Because it's not just a question of this quarter, right? The specialty chemical space has been seeing pain. Where do you think the pain points are, and especially when it comes to margins?
Yeah, first to the positives, I think it's been an extremely positive 9 months for us. Also a positive last 3 months in terms of the way we've been able to grow our volumes above the guided range of 6 to 8%. We grew by 8.5% for the 9 months, despite the challenging conditions globally. As we said, India has been a pretty bright spot for us. Europe is picking up pretty well. US has been a little bit of concern in terms of the destocking that is happening there. Africa, Middle East, Turkey is growing pretty well. The impact on the profitability majorly is due to the downtrading that is happening in all the developed economies because of the high inflation and the destocking that is happening in the US. We do see in the coming months this would reverse and would get us back onto the profitability growth that we have been delivering over the past so many years.
Why do you think that this trend will reverse? Some of the reasons you've listed in your investor presentation, Mr. Natarajan, include the Red Sea crisis. We don't know if that's going to reverse.
Yeah, so now the Red Sea crisis is something that's been that's a month old, and then there has been an impact initially when it happened suddenly. So the entire global economy is adjusting to it. There are increase in freight rates. But when I said that the things would reverse, I'm talking about the reversal we see in the specialty segment significantly, because US and Europe are getting back in terms of the growth there. The inflation is moderating there, and the interest rates are going to be reduced by the central banks there, which is good in terms of the disposable income that will be there in the hands of the consumers to enable them to spend on the prestige and the premium brands in which our products get in.
Okay. You've also had an EBITDA impact by one-offs. Your EBITDA and margin impacts, I believe, are by one-offs. Can you explain what this is in a bit of detail?
See, because we did have, the one-off essentially happened because the freight rates went up significantly when the Red Sea crisis happened. That did impact, and also in terms of the volumes in Africa, Middle East and Turkey got impacted because the shipping lines were just not taking material. It had volume impact for us. But for that, yes, we would have been well within the guided range of the EBITDA per metric ton of 19,500 to 20,500 per metric ton. And the other reason when we talk about the EBITDA in this quarter, in this 9 months being lower than the previous 9 months, also because of the export incentives that we receive in Egypt, which obviously is accounted on cash basis, which was there in the October-December quarter of last financial year, which is not there in this year.
So that's not going to be, that's not going to resume, is it? These Egyptian incentives?
No. So they are essentially, it's only accounted on cash basis because they do not come in a very regular way. So, as and when it comes, so you can't be accounting on accrual basis. So that's one of the reasons.
Okay. So the Egyptian incentives may not come.
Yes, correct.
Okay. Let me come to the point of America and Europe that you talk about, Mr. Natarajan, where you see things are changing. Now, your rest of world contribution is about 42%. What is the Europe and America piece of it, especially America, and where do you see that improving? Is there any guidance you can provide at this point?
Yes, if you look at it, our US market, typically US and Europe contribute to almost 40% of our rest of the world volumes. And if you look at that, we do see that, and majorly it is the specialty volumes get into these markets. So we do see the demand uptick happening in the specialty segment. We do see some green shoots. We expect that would sustain, and that would then enable us to increase our share of the specialty and super specialty products that we have, getting us into a growth of profitability.
Okay. Now let's come to a bit of your outlook. What do you see the EBITDA as per ton? Your margins, you say, have been better than guided. Do you see that margin growth consolidating or improving?
Yeah, we do see the margin growth improving because we do see the specialty segment getting back its onto a growth trajectory. We are continuing to guide the EBITDA per metric ton in the zone of 19,500, 20,500 per metric ton. We're extremely positive about the volume growth trajectory that we have been delivering in the top end of the guided range of 6 to 8%. And we do see profitability growth coming back on track with the specialty segment picking up momentum in the coming months.
Let's talk about the India piece of the business. Are you seeing more focus on India growing, volumes growing? Because I believe your volume growth in India is also at the best pace, right? You're still looking at double-digit growth in India compared to the rest of the world and your AMET markets, etc. So can you speak a bit to that? Where do you see the bump up there?
So India has been pretty good because India, we have been penetrating the market pretty well. India also has been with some challenges in the rural growth. We've been able to gain some shares as well, which has reflected positively in the growth that we have had. And we are extremely confident in terms of continuing with sustaining this growth momentum. We also see the demand sentiment in India also picking up with the various schemes of the government and the way spending is happening. And based on the commentary that most of our customers have given in their results, it also augurs well in terms of they expecting the rural demand to pick up, which would essentially aid further growth in the India market.
All right. So you're expecting rural demand to pick up. What about sort of prestige demand? Because that's also where some of your products come in terms of foaming, BPC, etc. Are you seeing an upswing there?
No, can you repeat the question? I didn't get it.
I'm saying you're expecting rural demand to recover, but what about more premium demand?
Yeah, premium demand, if you see, has been something that has sustained India, although the premium segment is not a big portion of the demand in India. We do see that also growing pretty well. But as of now, it's not a big portion of the demand percentage. So it's critical that the rural demand picks up to ensure that, the overall volumes grow. So premium segment demand in India has been growing. It has not got impacted, albeit at a very low base.
Absolutely. All right. So the outlook looks positive. They expect this kind of volume pressure to ease in the next few quarters. Is that the right way to put it, Mr. Natarajan? On when you see the pressures easing? Okay. So,
thank you.
So it's been a tough quarter, but they expect things to ease, the Red Sea crisis, etc., to also ease off. That was K. Natarajan, Executive Director and CEO at Galaxy Surfactants. We're taking a very short break, but before we get into that break, just a quick look at what's happening in the markets. And Hindalco is undoubtedly the story of the morning. Now, Novelis, CapEx outlook was bumped up 64% in this quarter numbers, and that's what's led to the pain point. Otherwise, on the face of it, the numbers aren't bad, but just the fact that they're going to end up spending a lot more on Novelis capital expansion than previously expected has seen the stock take a knock, 14% down as we speak. More coverage on Hindalco. The other big story this morning, of course, is the Paytm deep cut and downgrade by Macquarie down to 275 rupees is their target price. Let's see what's happening to Paytm after a bit of recovery that Paytm had seen in the last few days. Again, in a spot of pain, down 6%. In fact, Suresh Ganpati of Macquarie will be speaking after the break, both on Paytm and HDFC Bank. Stay tuned for that.
और जहाँ तक आपने पेटीएम रिलेटेड क्वेश्चन पूछा, हमने जो कहा था और जहाँ तक आपने पेटीएम रिलेटेड क्वेश्चन पूछा, हमने जो कहा था कि हम इस हफ्ते एक FAQ रिलीज़ करेंगे। मेरा अनुरोध रहेगा आप वो FAQ तक वेट कर लीजिए। और हम जो डिसीजन लेते हैं रिजर्व बैंक में बहुत सोच समझ कर लेते हैं। महीनों भर, 1 साल 2 साल एंगेज करते रहते हैं। कोई भी एंटिटी हो, वो बैंक हो, पेमेंट बैंक हो, NBFC हो, कोऑपरेटिव बैंक हो, किसी के खिलाफ अगर हम एक्शन लेते हैं, मैं पेटीएम के बारे में नहीं कह रहा हूँ, मैं जनरली कह रहा हूँ, महीनों उनके साथ इंटरेक्ट करते हैं, सालों इंटरेक्ट करते हैं, कभी कभी 2-3 साल भी इंटरेक्शन चलता रहता है। जब एक्शन नहीं देखते हैं, कोई एक्शन, इफेक्टिव एक्शन हमको दिखाई नहीं देता है, तब हम एक्शन लेते हैं। ये मैंने पहले भी हमने क्लैरिफाई किया हुआ है। तो इसीलिए बहुत सोच समझकर हमने फैसला लिया है। और अनाउंस करने के मतलब 10-15 रोज के बीच में कोई रिव्यू, वो जो आपने कहा, वो रिव्यू की कोई यहाँ पे आई थिंक वो जो वर्ड है रिव्यू अप्रोप्रिएट नहीं होगा। लेकिन मैं उसके साथ साथ ये भी कहना चाहूँगा कि आप जो FAQ हम इशू कर रहे हैं, उसके लिए आप वेट कर लीजिए। और फिर उसमें जो सारे कठिनाइयाँ हैं कस्टमर्स को, हमारा प्रायोरिटी ये है कि कस्टमर जो है, डिपॉजिटर जो है, उनको किसी तरह की असुविधा ना हो। इसीलिए हमने 1 महीने का टाइम दिया है एक्शन।
Hello and welcome to NDTV Profit. I'm Samina Nalwala and with me is Vishwanathan Nair, and you're watching NDTV Profit. And the big story once again this morning is Paytm. Well, the stocks of Paytm, Rishi, are down over 6% when I last checked, after foreign broking firm Macquarie downgraded 197 Communication to underperform and sharply cut the target price to 275 from 650 rupees. This is a 33% discount from yesterday's closing price. It's sub 400 now on Paytm. Vishy, not looking good. Even, I mean, the report that Suresh Ganpati has put out, the header says, downgrade, fighting for survival.
Yes, that's right. So, fighting for survival is the theme for Paytm at this stage. Things are not looking so great on the business front. Jan 31st, the Reserve Bank of India comes out with a set of strict restrictions, business restrictions on Paytm Payments Bank, which is a key associate of 197 Communications, the Paytm parent. Paytm Payments Bank is asked that after 29th of February, you will not add fresh deposits to the customer accounts. You will also not be allowed to conduct any kind of credit or top-up transactions. Customers are allowed to use their existing balances, but beyond 29th of February, it looks highly unlikely that things are going to go in Paytm's favor. We reported Paytm Payments Bank might be losing its license. That's probably where the Reserve Bank of India is headed to. Since then, a lot has happened on Paytm. People have gone to the government. Vijay Shekhar Sharma has approached the government to try and get some kind of easing of this restriction. Didn't really work out. But here we are, and we heard the RBI governor just now saying that...
just to talk about timelines, on 31st of Jan is when they imposed the major business restriction on Paytm Payments Bank. As of 12th of Feb, which was only yesterday, payment operators, Paytm's payment operator, 190 Communication Board formed a group advisory committee chaired by the former SEBI chief to work towards strengthening the compliance and regulatory matters. But no matter what Paytm or the parent company is currently doing, the markets don't seem pleased, the regulator is definitely not pleased, and brokerages as well are still coming out and cutting target prices. But we've got Suresh Ganpati on that note of Macquarie Capital. Suresh, good morning. What a morning, right? You put out a report, the stock gets beaten down, and the header of your report says fighting for survival. You've not only just cut the target price, but you've said that they will be struggling. You want to just take us through the interns of why have you cut the price down to 250 from the current around 400 rupees? So that's a 35% downtick from yesterday's close. What are the key concerns here?
Yeah, sure. So I think what we have always been telling here is that the most important business for Paytm continues to be its financial services business or its lending business. That is the partnership that it has with all the lenders. And they do have a great set of data, and of course technology also, which they used to leverage and act like a good digital DSC and source these customers and give it to the lenders, and the lenders are happy paying them a certain take rate. Now, the problem here is what's happened here is because of the restrictions which are imposed, which have been imposed in the Paytm Payments Bank, there is clearly a worry that there could be exodus of a lot of customers as well as the merchant ecosystem. If that indeed happens, clearly the lenders will have to reevaluate their decision or relationship with the with 197, which is the parent company of Paytm Payments Bank. Now, our channel checks reveal that indeed is the case. The lenders are reevaluating their position with 197. Could be for a variety of reasons. One of the lenders, largest lenders, has already reduced their exposure to Paytm by from 2,000 crores at the peak down to 600 crores now, right? So you have seen significant scale down by the lending partners, and there is a possibility that there are more in the pipeline, and at least some of them have obviously kept lending in a limbo for the time being. So all that is actually will have a corresponding, catalyst effect on the entire company and its business model of a profitability model. So the call that we have taken very clearly is the fact that there will be a significant reduction in the distribution business revenue, and that, remember, is the highest EBITDA contributor in our view. And in the issue of the fact that these numbers can come down quite significantly, we of course have changed our view and accordingly cut our target price to $275.
Right, Suresh, this is Vishwanath here. The question that I think a lot of people seem to be wondering is the future of the parent app with regard to where the payments bank is. But your report mentions the lending part, which of course you detailed just now. I wanted to get a sense as to, when the restrictions came in, the company came out and said 300 to 500 odd crore worth of hit on EBITDA. But it seems that the hit or the pain is going to be far more, far deeper and far widespread than previously anticipated when they spoke to the analysts.
Our view, obviously the company's view could be different, but note that at the end of the day, the impact is based on certain things which you can't do. But what about the impact which is coming from the fact that in future you will lose customers and you will lose certain proportion of your lending business? That obviously no company can quantify and be more futuristic, and that's the call of analysts like us, right? So we are taking a call that there can be a reasonable exodus of customers as well as merchants, and that could have a significant implication with respect to their lending abilities, and consequently that the segment of the revenues will also get affected, and consequently profitability. So the 300 to 500 crore impact doesn't take into account a lot of futuristic developments which could very well play out, not necessarily as per the management's expectations, right?
The one part that came out, we reported here as well as some other news reports out there talking about compliance specific issues. What seems to be playing out is also a reputational problem, apart from, of course, the financials and the impact of these norms on the customer base. The reputational hit, of course, also impacts future business relationships. Just take us through what could maybe hit Paytm through because of this reputational problem.
It's already seen in the case of the fact that the lenders are relooking at the portfolio or the relationship that they have got, right? And also the fact that because of whatever issues that has happened and Paytm Payments Bank operations have been severely restricted by the Reserve Bank of India, what's happening here is any new onboarding of customers will also require a very detailed KYC check to be done. So it is not that tomorrow Paytm can get up and sell their crore merchants to the banking players, right? Any bank who is going to take, for example, the nodal accounts from Paytm Payments Bank, they will have to do their own significant due diligence and KYC of each and every customer or merchant that they are onboarding. That makes the entire process cumbersome. And that's a function of some of these regulatory actions and, as you said, the reputational issues which have been brought to the fore.
29th February deadline then seems very tight considering the task at hand, right?
Yeah, of course. Yes, it's a difficult. I mean, that's what we don't know. The media was speculating. You guys were speculating that he went and met Reserve Bank of India and Nirmala Sitharaman, Finance Minister. So obviously, I guess that close shows the gravity of the situation as to why, I mean, those kind of meetings, as per the press reports, were required because maybe there's some relaxation that they sought out for. But clearly today also, Reserve Bank of India governor has gone ahead and said that there is not going to be any rethink on the decision and it's final, right? So.
Right. Suresh, so all of this that you mentioned, you obviously don't believe is already in the price, right? And hence you've downgraded the stock to levels of 250 odd.
Yeah.
When you looked at the valuations of this, up until the early Jan, you could get multiple businesses for 197 communication in terms of pricing and valuation. From where it stands right now, and when you value the company or value 197, is that 250 rupee price per share only valuing or taking into consideration the UPI app that may be untouched or may survive for now at least?
No, first, my target price is 275, not 250. Just the technical correction there. But but look, I think we were always of the view that whether it is UPI or whether it is wallets or whether it is various other commerce services and soundbox services that they provide for their merchants, everything at the end of the day boils down to, more like an EBITDA neutral kind of a position, because obviously they also have to make a lot of tech investments. And that helps them to retain the customers in the overall ecosystem. And on top of